Go.
Greetings, Dr. DeSalke and board members. It's Assiya Lewis and Michael Vines here with a fintech merger proposal for Block and Ramp companies. Today, we will discuss an overview of the companies. We will discuss visual presentation of the business model. That is, in other words, a general holistic and complete overview of the company's workings, customers, revenue streams, and etc. We will also review financial feasibility canvas, a financial analysis that will help finance managers make decisions on a project by evaluating all the financial aspects of it. And then we'll transition to intrinsic analysis and extrinsic analysis. And at the end, we'll finish up our presentation by summarizing our findings and providing recommendations. So, about the companies. Ramp Company, formerly known as Axiom Holdings, is a San Francisco-based software as a service company that offers a data connectivity platform. Ramp major products and solutions include Authenticated Traffic Solution, ATS, Cloud, Advanced TV Measurement, Identity Resolution, Data Activation, Data Collaboration, Data Marketplace. Ramp operates a data collaboration platform in the United States, Europe, the Asia Pacific, and internationally. Now, on the other hand, Block Company, formerly known as Square, is an American multinational technology conglomerate founded in 2009 and launched its first platform in 2010. It has been traded as a public company on New York Stock Exchange since November 2015 with the ticker symbol SQ. It is a financial services and digital payments company, and it provides a range of services including payments platform, point-of-sale hardware and software, financial and marketing services, cash app application, and a seller ecosystem. Now let's dive into our analysis. Should we, Mike?
Okay, so the business model canvas. We're going to look at the key partners for our company, Live Ramp Holdings Incorporated, that we anticipate to acquire. Key partners for Ramp are the Sutton Bank, the Celtic Bank, and the Grasshopper Bank. They're all partners for the Visa commercial credit cards that Ramp offers. Finley Software integrates the accounting to do transactions and layers that will verify nodes across the customer's networks as well. This primarily serves the payment systems and invoicing systems that Ramp provides small and medium enterprises. The key activities are the first product on the platform were the corporate cards. Followed that by software integrations that allow businesses to control spending, automate accounts payable, and update bookkeeping records in real time. An important note is that Ramp is the fastest growing corporate card to ever reach $100 million in transaction volume. Platform development has improved over time. It's added expense management software, providing financial products, utilizing blockchain as a security measure, and offers 24/7 customer support. Expensify and Concur are two competitors who are incumbents in the marketplace, but Ramp offers basic services that these companies provide on their free platform, which is a great segue to value propositions. Value propositions for Ramp are going to be simplified spend management solutions for companies, including travel expenses, accounting automation, and greater visibility and control over their financial operations and records through an easy-to-access dashboard. They differentiate themselves by providing 1.5% cash back on business expenses, faster payment processing, smart card management capabilities, and real-time insights into spending patterns for each individual business. Customer relationships. Ramp cultivates customer relationships through user-friendly interfaces. Their model is designed to help businesses save money, and they do not charge for their most basic subscriptions. Ramp offers excellent customer support and dedicated account management. They also provide tailored onboarding experiences to ensure their customers can maximize the value for each product. They primarily serve small and medium-sized enterprises, but more large companies are starting to sign on. They're averaging around 1,000 new users per day. The channels for Ramp to grow its business primarily leans upon digital presence through their website, online advertising and marketing, social media marketing, and strategic partnerships that generate referral systems. The key resources for Ramp, the core resources for Ramp include web-based platform, skilled software developers, knowledgeable finance specialists, sales and marketing professionals, and strong industry partnerships. Ramp generates most of its revenue through the transaction fees, transaction fees that are made on their corporate credit cards. They charge about 2.5% per transaction. 2% of that goes to the partner who issues the card and processes, and 0.5% of each transaction goes back to Ramp. They also sell services through Ramp Plus and Ramp Commercial, which is a subscription-based paid platform. Their cost structure, major costs for Ramp are going to include software development, maintenance and infrastructure, sales and marketing efforts, and employee salaries. Any partner and vendor relation related expenses are going to go back to those referrals that we discussed earlier. Which leads us to the financial feasibility canvas. The investment rationale behind Block acquiring Ramp is primarily to expand the scope of services that Block provides, as well as accelerate the growth potential that Ramp is starting to exhibit. The synergistic implications emerging the two companies who symbiotically rely on revenue from credit card transactions is an interesting proposition. Block's proprietary credit card through Square is something that could be integrated into Ramp's current offerings. Block, as I said earlier, Block's ability to accelerate Ramp's growth curve and turn them into a profitable organization would be beneficial from both sides from our perspective. Capital investment aspect is Ramp has raised approximately $1.7 billion in 9 rounds of funding. Approximately $700 million was generated in debt financing, and their latest round yielded $300 million. Currently, the company has an enterprise valuation of $1.43 billion, which is relatively small compared to some of its competitors in the marketplace, if you look at the extrinsic values later. Some assumptions that we're going to operate on is that revenue is going to continue to grow. It was reported at $154 million in June of 2023. That's up 8.31% year over year. Negative net income is negative. As I said earlier, they have yet to show sustained profits, but they are trending in the right direction. That's up 94.17% year over year. Operating expenses are down 15.88%, and they continue to go down. With approximately 15,000 users, Ramp is reported approximately $608 million in revenue. So this brings us to an above average revenue per user ratio, which is something to think about. While profit margins remain negative, they are trending in positive territory, and they're aggressively paying off debt and reinvesting in growth. Their cash flow, the EBITDA right now is valued at $6.43 million as of the second quarter of 2023. That's a 133.6% increase over Q1. So they're definitely taking on they're definitely taking on some some growth in that area. The debt ratio is at 21.07%. That's so that income to debt ratio. We're going to assume that they're going to continue to grow in their their revenues, and their debt is trending down. So that's a fantastic point to look up. Updated free cash flow is 71.16 million as Q1 and Q2 combined in 2023. And their CapEx, however, is negative at negative 39.28 million based on a year-over-year calculation. So there's definitely some positives and some negatives. It's a mixed bag in here. The financial returns is what we're going to look at next. The average rate of return over the past 5 years has been 22.8%. Their comparative market performance is mixed, but acquiring the company coincides with minimal exposure to risk of debt, with a cash flow to debt ratio of 320.38% compounded over 5 years, which far outgains its competitors, as you'll see in the extrinsic analysis. The volatility of the company should be considered as a risk, and as well as the company not showing any profits yet. So in our entrepreneurial decision, some things that we're going to consider. Ramp is a growing company who's been able to raise significant funds through 9 rounds. They maintain positive free cash flow and reinvest in assets to promote their growth. The volatility and lack of profitability of the company should be considered, but the synergistic pairing of the two companies do have inherent values. We're going to kick it over to Assiya, as she's going to walk us through the intrinsic analysis.
Thank you, Mike. We did analyze both block and ramp in intrinsic analysis, and this intrinsic analysis focuses on internal attributes and historical financial performance of block. According to this chart that you can see here, block's revenue has shown significant fluctuation over the past 6 quarters. Revenue has grown from 3.9 billion to 5.5 billion, with a steady increase and strong growth in the last quarter, indicating a positive trend. As far as operating efficiency, measured as operating expenses as a percentage of revenue, has been relatively stable with some variations. It decreased from 39% to 34.5% over the past 6 quarters, which is a positive sign, as it suggests the company is managing its expenses more effectively. Now, if we look at the debt as a percentage of total capitalization, the company's debt as a percentage of total capitalization has fluctuated between 6.6% and 15.6%. While there are some fluctuations, the debt levels seem manageable and not overly concerning. The inventory turnover ratio has shown fluctuations with values of 162.3 and 145. This indicates that block might have periods of high and low inventory turnover, which should be further investigated to understand the reasons behind these variabilities. Now let's look into the RAMP's intrinsic analysis. The revenue growth for RAMP has experienced fluctuations over the past 6 quarters. It increased from 0.1 billion to 0.2 billion, with significant growth in Q4 2022 and a slight decline in Q1 2023. Excuse me. Operating efficiency measured as operating expenses Operating efficiency measured as operating expenses as a percentage of revenue has shown variability ranging from 68.8% to 104.1%. The highest operating expense as a percentage of revenue occurred in Q1 2023, which is a concern and should be further investigated. Debt as a percentage of total capitalization has maintained relatively low debt levels as a percentage of total capitalization, with the values ranging from 2.3% to 4.6%. As far as the inventory turnover ratio, the company does not appear to have inventory turnover, as all values are 0, which is typical for companies that do not maintain significant physical inventory. Now, in the next slide, EBITDA, RAMP's EBITDA has shown a gradual increase from 0 billion to 0.02 billion. This reflects improved earnings before interest, taxes, depreciation, and amortization. The company's profit margin has varied, with the highest margin, 16%, recorded in Q4 2022. However, the margin dropped to 10% in Q1 2023, suggesting some level of profitability volatility. The forward PE ratio has shown fluctuations, with a decline from 21.1x to 14.7x in most recent quarter, indicating that the market expects improved earnings in the future. The PEG ratio has experienced positive trends, increasing from negative 1.68 to 0.91, indicating improving growth expectations. The price to sale ratio has fluctuated, with a recent value of 3.2x, suggesting that the company's share are trading at the multiple of its sales. The price to book ratio has shown variations, with the most recent value at 2.1x, indicating that the shares are trading at a multiple of the company's book value. The enterprise value to revenue ratio has also fluctuated, with the latest value at 9.7x, reflecting changes in valuation relative to revenue. And lastly, the enterprise value to EBITDA ratio has shown fluctuations, with a recent value of negative 42.4x, which may indicate unique financial circumstances of challenges. This is all for the intrinsic analysis. Now let's look over extrinsic analysis, and Mike will share that with you.
Thank you, Assiya. Extrinsic evaluation findings. When surveying the landscape of software as a service providers, finding comparable targets to Ramp is in itself a moving target. Their offerings are unique and span across a lot of different platforms: corporate card issuance, expense management, software, bill payments, and vendor management. In fact, most of their direct competitors are smaller companies who remain privately held. Nonetheless, by using a combination of Capital IQ resources along with some interesting research papers that we've cited, we've identified some benchmarks who can give us perspective on Ramp's positions. We're going to primarily look at Expensify, Bill.com, and HubSpot to be included in our extrinsic analysis. While they're unique differentiators, these companies will provide essential services that Ramp provides in their suite of products. First, we're going to look at the sheer size. Market cap and enterprise value. You can see Ramp is relatively small, definitely smaller than average of the companies we're looking at. Bill and HubSpot are definitely much, much larger companies, and you'll see this reflected in their financial statements. Clearly, Ramp is a small company in comparison, but the lower enterprise value means minimizes costs for companies that are looking to acquire them. They're positioned well and below average in total valuation. And in addition to the objective information we could derive, we're looking at some comparisons like the market to book ratio that Assiya alluded to earlier in the intrinsic evaluation. You can see these numbers as compared to other players in the field, as well as the margins on the EBITDA and EBIT. Remaining below 10% on the EBITDA, it's looking pretty good for Ramp. The obvious pain point for Ramp is their inability to reach profitability. Their compounded market equity returns over the 5 years is the biggest red flag I was able to find from any perspective. They fall well below the average of any other players in the field here. So that's definitely something that we should be considering. A few redeeming factors, and that you may want to make a case for Ramp, as we look at cash flow. Cash flow, we're well above the 5-year average when we compound the cash flow over 5 years. The revenue per customer is only superseded by HubSpot, but again, really well above some of the competitors that are closer in their market cap. And the stock price momentum, there's not a whole lot of volatility in their stock price. It's just a slow and steady line where we can see a slight incline. again, with the stock price momentum, the run rate was something that I wanted to look at. A lot of investors have paid attention to the run rate, and it seems as if Ramp is trending in a positive direction and keeping in line with a lot of the competitors in the market. So as we've run our intrinsic and extrinsic, we're going to kick it over to Assiya to run our summary, and thank you very much.
Thank you, Mike. After analyzing these two companies, we came to this summary. The analysis of Block and Ramp reveals notable differences in their financial performance and market positioning. Block has experienced significant fluctuations in intrinsic and extrinsic metrics with challenges in terms of negative trail PE and EBITDA figures. In contrast, Ramp shows more favorable PS and PE ratio, though it also faces challenges in terms of extremely negative EV/EBITDA and EV/EBIT ratios. Given the substantial differences in their financial health, a direct merger might not be advisable. This is what we kind of decided. For successful merger, both companies should work on stabilizing their financial metrics and improving their profitability. Collaboration could be more viable through strategic partnership or joint ventures rather than a full merger. Block might benefit from Ramp's better valuation ratios, while Ramp could leverage Block growth potential. Under such a scenario, these companies could explore synergies in specific areas like technology development or market expansion, ensuring more successful collaboration without bearing the immediate challenges of a merger. Now, this concludes our presentation. We have also this page for resources that we've utilized during our analysis. We want to thank you all for your time, and we hope you have a wonderful day. Thank you.
Thank you.